In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. That quote comes from Benjamin Graham, Warren Buffett's mentor, and it gives profound insight into intelligent investing. In the short term, weeks, months, or even a few years, the stock market moves unpredictably. The world's best investors can't, at least consistently, tell you which way it'll move. Market prices and valuations can stretch way past their underlying fundamentals. This is largely due to mass investor psychology, and relating it to that quote, it's the voting machine at work. But over the long run, there's mean reversion and balance. To put short-run pricing into perspective, just as you would submerge a beach ball below the surface of the water, pressure builds. And the further you push it below the surface, the faster it can snap back up to equilibrium. We don't know how long someone will hold a beach ball below the surface or how long stock mispricings will extend. There have been many financial bubbles and they've lasted different durations. But over the long run, they generally bounce back to the surface or to the averages. That's why I'm personally a long-term investor, along with tax advantages and a few other benefits in mind. Still, I like to track the stock market's current valuation out of curiosity. And one telling metric is the S&P 500 PE ratio. It's been a pretty good indicator of future stock market long-run returns. Now, before I show you the useful chart I put together, I'd really appreciate it if you just tap the like button down below. This Frugal Fortunes is just a side passion project where I share my investing insight, as well as what I'm putting my real money into. So I hope you subscribe and stick around. All right, I've compiled over 60 years of stock market returns, along with the PE ratio, and have found a useful trend. The chart that I'm throwing up on your screen matches up the rolling S&P 500 PE ratio and the following 10-year returns. So I've taken those 10-year forward returns and pushed them back to the PE ratio. When the PE is high, long-term returns go down. This is an inverse relationship, and I'll give you a second here, but I have a slightly better correlation chart. So in the second chart, or correlation chart, there's a good deal of dispersion, but there's still a clear trend. On the outsides or the extremes, there's less variance, but there's also less data to work with. Now, how is this useful for investors today? Well, at a current PE ratio of above 28, the stock market could very well return close to 0% over the next decade. Now, it's important to note that this is based off of history as a guide. Really, that's the only thing we have to make informed decisions going forward. But on occasion, there are new normals or what can be called regime changes for my fellow statistics nerds. And the Fed is really manipulating the stock market at an unprecedented level. It's artificially pushed down interest rates, and that's really propped up a lot of different asset prices. For example, home prices are at all-time highs once again, even after adjusting for inflation. The housing market is a beast of its own, so I put together a video on that topic. I'll link to it here, and I'll also drop a link to it down in the description below. Now, two last notes before I sign off for this week. Up first, how am I personally investing with an overvalued stock market? As always, I'm looking for individual companies. On average, it is harder to find better deals, but there are still a few gems when digging through the rough, which if you subscribe, you'll find out when I invest in one and why I'm investing. And once again, I'd really appreciate it if you just tap the like button down below. Now, my final note is about an idea that ties very closely to what I've shared today. It's measuring the stock market's valuation with what's called the Fed model, or the Fed and Yardeni models. I'll link to that research here I put together a while ago, as well as leave a link down in the description down below. Feel free to check those out. And also, please leave any comments or questions down below. I'm usually pretty responsive.